Hello, everyone. My guest today is Jody Glidden. He's been CEO of Introhive since it was founded 7 years ago. He's a frequent blogger and speaker on topics of sales acceleration, especially among enterprises. Jody, are you ready to take us to the top?
Yes, I am.
All right.
Thank you.
You bet. Tell us about Introhive. What's the company do, and are you a pure play SaaS model?
Yeah, sure. We are pure play SaaS. It's a system that looks at all of the enterprise data sources, uses machine learning, and tries to make sense of it. It creates various different use cases and applications for helping to accelerate sales. Things like creating a searchable relationship graph that salespeople can use, and a bunch of other things.
Very cool. And give us a general sense of kind of pricing. What's the average customer pay per month or per year, would you say?
It depends on the size of deployments. We have some customers that are 100,000 employees or more. They get better pricing, obviously, and then there's smaller companies, but somewhere in the $20 to $25 per seat per month range.
And sorry, do that at actually a company like logo level. So on average, are you signing up like 30 seats, 100 seats?
Oh yeah, most of our deployments are pretty large. As far as what you'd normally see in SaaS, we don't really do the normal SMB model. We are primarily companies of 500 people or more.
Okay.
We do have a few smaller customers that might have 100 or 200 seats, but that would be rare.
Okay. And so if the average is kind of 500 or more, what does that look like in terms of ACV?
We're kind of in the 8 digits sort of size now. So we're just kind of, we're tripling every year.
Sorry, not you as the company. I meant the annual contract value on that kind of new logo signing up.
For somebody of 500 seats?
Yeah.
Yeah. They're usually, depending on what products they choose, because we have a number of products, but a lot of companies start with us in around that $100,000 a year range.
Cool. Yeah, that's really helpful to understand. All right, so about $100,000 first year ACV. Again, huge range, but that's kind of a good kind of average, middle of the ballpark kind of thing. Put this all on a timeline for me. When did you launch the company?
Really at the end of 2011, start of 2012. That was when we raised our first money and kind of got more serious about things.
Okay, and where were you personally at that part in your life? Did you just quit corporate or what?
Yeah, I had just, me and my partner Stuart had a previous startup. We were acquired by BlackBerry, and that was in 2008, 2009 when BlackBerry was really the only smartphone game in town back then. We stayed with them for a couple of years, took different roles, and then I left and started this. Then we raised money shortly after that, and Stuart jumped over shortly after.
That's great. So how much have you raised to date?
We've raised around 15 million or so.
And there was never a thought to go on, you know what, we have the money, let's just bootstrap this thing.
No, we did put some of our own money in as well. There's been, some equity raise, there's been some of our own money, and there's also been, we have a lot of our people in Canada, and the Canadian government has also helped with some grant money and stuff like that. So total financing in is probably closer to 20.
Okay.
Total from VCs would be closer to 15.
Yep. But my point was, though, again, it sounds like you had some success in the past. Why raise VC at all? Why not just keep using your own money?
It's a lot of risk. I still believe that it's worth it to have a financial partner. I have a friend who had a very, very successful startup where he got, 100, 150 million personally. And he's tried since then doing 2 or 3 startups, and he lost most of the money that he got. You can still do very, very well getting in some financial partners, and if you pick the right people, you don't really lose a whole lot of control in doing that.
Yep. So 2012 is kind of launch date, 15 million raised today. And what have you scaled to today in terms of total customers using the platform?
So we're around 50 customers or so.
Okay. So this is very much kind of a super high ACV, kind of high touch, longer sales cycle kind of process.
That's right. Yep. Yeah. We have a lot of customers in the, $500,000 a year range. We've got some in the $1 million or more a year range. So it's definitely at the higher end. We're starting to move that down. So a lot of people started SMB and moved their way up. We actually started at large enterprise and moved our way down.
And why is that? Why were you able to do that?
Well, because of what we do, it's very, very sensitive data. So, we're taking the most trusted assets of an enterprise and we're helping them make sense of it. So you have to do, if you want to do it properly, you have to put a lot of time and energy into your security, encryption, all of the architecture of your system to make sure it will work properly and that there's no breaches. So once you do that, the next, I think a lot of people start at the SMB because they can have a really simple, minimal viable product and then move up over the years, put more and more time into it. With ours, we couldn't really have a minimal viable product unless we already put a lot of work in. So we thought at that point, you might as well recoup it by selling into large enterprise.
Yeah. It's funny, if I just view the website, Introhive.com, and I scroll down, I mean, and don't take offense to this. This looks like a company that could be from a CRM that like just launched yesterday. In other words, there's nothing that I realize, wow, this is enterprise, until I get down to our customers and I see PwC and Reed Smith, and I'm going, maybe there's something else going on here. But nowhere do I see like, the only CRM to protect against security breaches or handle your most like sensitive data. Why don't you lead with that?
Yeah, we talk about it a lot in our blogging and in our thought leadership stuff and at conferences and stuff. But we probably don't make it as front and center as we probably could, because I just, we onboarded a half dozen employees today. And one of the things that I mentioned in the speech to them, the kickoff thing with the guys was, for a company of our size, it's almost our logos are almost unheard of, and it's not, we're not one of those companies that has, 5 seats at PwC. We've got 100,000 seats at PwC.
Yeah.
And it's like that with a lot of our customers. Our customers are, giant banks and the biggest law firms in the world and the biggest tax. They're the most data sensitive companies in the world. So it's I think it's something that's unusual about us for sure, just because of kind of how we had to build the solution.
Yeah. And you said you just recently passed $10 million in ARR.
We're right. Yeah, that's
or
right
about right now.
Yeah, and then we're tripling every year. We have a goal to triple again in 2019. It's going to be hard to keep that forever, but that's
yeah. Well, but I mean, so if you're doing 10 million run rate today means you're doing about 830 grand a month, and if you just tripled that means you were doing what, about 250 grand just about a year ago per month.
Yep, it's been pretty consistently for the last 3 years. We've been tripling almost on the dot.
It's an impressive. That's obviously, they say, what is it? Triple 3 times or triple 2 times, and then double, and you set yourself up for kind of IPO if you want.
Yeah, that's right. We're working really hard. I mean, we have to watch all aspects of the funnel, the top of the funnel and the bottom of the funnel, to make sure that there's enough leads. Because if you look at the length of our sales cycles, we have to think pretty far in advance in order to make sure there's enough pipeline to have it closed in time. But so far, I think the guys are doing a really good job.
What is that pipeline right now? What's the timeline?
Our sales, it's somewhere around 6 months. Actually, we're just starting to get below 6 months now on the average. So, but really close to there, which, in the old days, it would be like 2 years. so we've moved that in a lot.
Yep. Now, it sounded like your starting contract value is called maybe 100 grand, and it obviously goes up from there. What are you willing to, how aggressive are you being? What are you willing to spend to acquire $100,000 of new ARR? I don't think we pay too much attention to our sales costs or our marketing costs at this point, because, there's a really good return on the revenue that we bring in. Since it's high margin revenue, there's a really good return. Our valuations tend to be somewhere in the 20 times forward ARR level. So when you're looking at that, like if you brought in $1 million deal and you spend $1 million to get it, although we've never even came close to spending that much money, but even if we did, let's say, spend $1 million to get $1 million deal, there's a great return on that right now. So we're not trying to be profitable or anything like that. We're actually doing Jody,
well.
Sorry. Payback period has very little to do with profitability. That's just a sense of how long of a cash gap do you have to withstand before you get your money. Is it a short cash gap, or can you afford to have a longer cash gap since you raised so much money?
Yeah. But we have great access to capital, and we always have. So the great thing, the reason we look at valuation so much as one of our metrics is that we know that's a source of financing for us at any time we want to draw on it.
Well, assuming the market stays frothy.
Well, we've got multiple sources though. We've got debt financing available to us. We've got equity financing available to us. We've got founder financing available to us. So if you look at, the really bad recessions, they usually don't take, the markets usually don't dry up. Take 2008, markets didn't dry up for more than like a year and a half. So, that's not a big gap to close for us. We're not too concerned with it.
Well, I mean, just to be clear, though, when you're talking about valuation, so right now, I mean, there's a lot of people talking right now in the SaaS space about this, where if the Fed fund, like if you value a SaaS company as an asset, and you're doing essentially a discounted cash flow model on it of, call it 50 years, something really long since recurring revenue, the discount rate is going to be 1 divided by whatever the Fed funds rate is right now, right? So if the Fed funds rate goes higher, every percentage point it goes up, but, right now a SaaS company you could say is essentially 50x. Well, if the Fed funds rate goes from 1% to 2%, well, now it's only 20x or 25x. And if it goes up to 3%, it keeps going down. So there's a lot of people saying if interest rates keep going up, how they're going, actually valuations are going to get squeezed in the SaaS space. So I'm just wondering how you say with such confidence that no matter what, you can kind of rely on that valuation for any kind of funding.
Well, because I think there's two things there. One is what's our valuation, and obviously that's going to fluctuate. At the moment, it's a very high multiple, even if it went to what's seen as a pretty historically low multiple. It's not. We've got a lot of room to move on a typical deal. Our sales costs and our marketing costs are actually a very, very small fraction of the deal.
I'm just curious, like how small though? Fully weighted.
It varies pretty widely whether you're talking about a company like a very, very large enterprise with a couple 100,000 seats. You might see a sales cost of $50,000. Or if you're dealing with, we actually had a very large company that came inbound to us as a referral from another customer. We closed them in 60 days with almost no sales costs. So, I think even if we do kind of go, all out and we're spending a lot of client time on site with the client and everything, it's just not even one of the factors that we really worry about in terms of, should we try to spend less and get less deals?
Actually, that's not what I'm saying. I'm actually saying the opposite. Like you keep talking about it like it's a negative. I mean, but I've actually, most of the companies that go from that I've interviewed that go from 30 million to 90 million in ARR, they actually get more and more predictability around, they know they can spend $1.20, right, for a new dollar of ARR. And so you have to obviously start spending more money to build out your cohort to figure out what you can consistently get. I'm not trying to say you should spend less or less or less. I'm actually arguing the opposite.
Oh, okay. Well, maybe that's what we're saying then. What I thought you were saying is that we should be spending, or we should, be more careful with how we spend on our sales and marketing costs. But I just don't. That's not something. When we're looking at our most important metrics, the amount that we're spending, it's a very small percentage of the overall. The things that matter most to us in getting good margins are things like our hosting costs, our security costs. Those are through the roof. It's very expensive for us to deploy private environments for these large enterprise customers. For example,
they're not on-prem stuff, are they?
That we do private encrypted cloud, so it's like a SaaS model, but PwC can own it, for example, if they want. So that's pretty expensive for us to do, and we're always looking at ways to try to make that more efficient. Interesting.
When you look at gross margin, I mean, are you still though in the 80-85% range, or are you lower because of the security, the hardware?
No, we're like 85 to 90%.
Okay, I mean, well, that's right in a good range.
Yep.
Okay, but so let's ignore CAC for a second. I'm just trying to get in your head in sense of aggressiveness. So a payback period, if you land a $10 a month account, obviously, and you spend $1, right? That payback period is called 10 months, but you can multiply both those by 10 and the payback period is 10 months. I'm just kind of curious, from an aggressive perspective, are you willing to spend up to a year or first year ACV, no matter the size, to get the customer, or you want to do less than that?
No, I think a year is still fine at this kind of stage. Right now, the most important thing for us is we're not operating in a bubble, right? This is becoming a very, very hot space, and we have to make sure that it's a bit of a land grab. We need to get as many big logos as we can, as quickly as we can, and do a great job in retaining them. So that's our goal. We've got our foot, fully to the floor, and if in the early days, maybe not quite so much, but as soon as the space started heating up and you see big potential entrants and things like that, let's try to just spend what we need to and get as aggressive as we can. Not be silly about it, but I think spending the first year on sales and marketing costs is fine.
Mm-hmm.
In my view.
Makes sense. Talk to me real quick before we wrap up. Obviously churn is critical. It sounds like you, I think, probably have net revenue retention above 100% at this point. Is that the case? And if so, what's the kind of the gross revenue churn per year?
Yeah, we have almost no churn. So and if you look at it from, so the types of customers that we've had hit the pause button, essentially our system, most of the time, for most of the use cases that people do, it's trying to improve a CRM that nobody was using. So our system goes in, does a bunch of automation, and all of a sudden now there's great data in the CRM. The problem is we've had some organizations where customers have said, we need to switch CRMs because we were with this company and now we moved to that one or whatever. A lot of times that's a 2-year pause. So if that happens, we have to go pause as well. Is that churn? I don't know. But other than that, among our enterprise customers, we haven't had any churn at all.
Mm-hmm. So when you look at this on a cohort basis, so like the cohort you signed up a year ago in October of, call it 2017, let's say that was worth $500,000 in ACV. This year, when they're renewing in October, what have you expanded that to? Does it go up to 750 or $1 million?
Yeah, our expansions haven't generally been that dramatic. There have been some, especially so when you have a customer of, let's say, 1,000 people, a lot of times we'll get fully deployed on day one. If you have a company that's operating in 50 countries with 300,000 employees, a lot of times we start with 10 or 20,000 seats, and we deploy country by country by country throughout the months and years that follow, and then we'll add on products and so on. So with very large companies, there's a lot more dramatic expansion. In the smaller companies, not so much.
Mm-hmm. Got it. But again, that's why people tend to just look at like net revenue retention on a cohort, because it doesn't matter if you're big or small. You just look at total churn revenue and total added. Do you know what those numbers are yet, or no? You're just growing so fast, you're not looking at it.
Yeah, we're not really. We only have about 50 customers, right? So most of them are. We have a pretty good split of large enterprise customers where they're. We're looking at things like how are we moving the ACV from year to year, which has been growing at about 20-30% annually.
Okay,
ACV.
by the way, that's it. That's what the expansion revenue would be then, right? So you have about a 20% expansion.
Yeah, well, we're expanding the revenue per seat, but we're also expanding the number of seats. So it's both sides.
So when you add both those percentages together, then it was more like 30-40% or what?
Yeah, probably more like 50%.
Yeah. Okay, good. I mean, obviously that's really healthy. So last question, you're on team. What's the team size today?
We're 120, 125 people.
That's great. And you said half dozen today?
Yeah. The last few weeks we've been doing 4 or 5 every week.
That's great. And where's everyone based?
Well, we've got a lot of people in Fredericton, New Brunswick. That's where we kind of started with our engineering team and so on. And customer success is there, customer support. We have a team of about 30 or so in Chennai, India. That's R&D mostly and some support. And then we have our sales team, we have about a dozen salespeople in London. We have some we have a Chicago office now with a half dozen people or so. And then a bunch of other people that are dispersed around.
Mm-hmm. Very good. All right, Jody, let's wrap up here with the famous 5. Number 1, what's the last business book that you read?
It's Never Eat Alone.
Number 2, is there a CEO you're following or studying right now?
Probably Benioff.
Yeah. Number 3, what's your favorite online tool for building your business besides your own?
I'd say, I'd say, reporting tools. We went through a few different ones, but I love the dashboarding, KPI reporting tools.
Well, yeah. So which one do you use?
We went from Tableau, Business Objects. Now we're doing our own thing, but name a tool that my listeners, if they think like they want to try it too, could also try it. What's a tool that you use to grow the business? Tableau is a great tool.
Okay, but you switched away from it.
Yeah. What's that?
But you switched away from it.
Yeah, exactly. It's expensive, and we're all still kind of in the reporting business. So we had, I'm not trying to pitch myself, but I think that reporting is a great thing. Tableau has a great tool.
All right. Number 4, how many hours of sleep do you get every night?
Probably 7.
Okay, that's
Not
not
too bad.
horrible. And what's your situation? Married, single, kiddos?
Yeah, I'm single.
So, okay, no kids that you know of?
No, I do have a kid.
Okay, good. You do this. So good. I'm glad I asked. All right, not married, one kiddo, and how old are you?
I'm 45.
45. Last question, Jody. What do you wish your 20-year-old self knew?
Just to work as hard as you possibly can because it's so much fun and you learn so much.
Yep, guys, there you have it. Work hard, especially in those younger years when you can and you don't have a lot of responsibilities yet. Coming from Jody, founded Introhive back in 2012. Today, past 10 million bucks, or they're doing about 10 million bucks right now in ARR. They're about 3xing year over year. So healthy growth. 50 companies paying them per month, very much in the enterprise space. 15, that's 15 million raised. Net revenue retention over 100%. They've got about 125 people in a bunch of different remote locations. Payback periods, pretty low. When they do want to get aggressive, though, he's happy to spend up to 12 months to acquire the customers in a very, very hot space. Jody, thanks for taking us to the top.
Great. Thank you.